VINCO Ventures stock has been a popular topic of conversations since 2021, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should buy the stock. So, as the market is still very volatile at the moment, we should always be mindful about which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. VINCO Ventures has been going through a very difficult sequence of price actions recently, and the stock hasn't really recovered since the data support level that has held the ground pretty much every time since the past 12 months gave up on the stock. In my opinion, I think that the recent spin-off, as well as the potential short squeeze that went off the gas on VINCO, are the events that have now brought the stock under a new perspective, from which we should reevaluate if the stock deserves a second chance. So I believe that as far as a potential stock with a quick upward momentum is concerned, those days are now behind us. The market has now mostly moved on from the title, and it may have to come up with new reasons to eventually motivate the retail investors to come back, if ever. With that being said, there's still one major appeal on VINCO, and that is its current price level as well as the key asset called Lomotive. I believe that the stock price down to where it is now, there is additional downside, but it is significantly less important than the possible upside. Most of the time, there won't be any reason for a significant uptick, but frankly, sometimes the market is not that rational. What may happen is that the market as a whole could take off for a brief period of time because the movers within the sector has had a major update, resulting in the rest of the stocks to also move in the same direction. We have seen this phenomenon with EV stocks as well as the crypto market. Now, let's also take a look at the technicals of the stock. The trading volume of VINCO has recently been 9.6 million shares versus the average volume of 15 million shares. Over the previous 52-week period, the price fluctuated between $1.04 and $12.49. The trading volume is a metric that can tell you how many shares are being exchanged hands and whether there's a lot of activities and momentum on the stock. It often gives us a first idea about the popularity of the company. When we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it could signify that a trend reversal could happen sometime soon. The market cap of VINCO Ventures is currently around $296 million versus the enterprise value of $232 million. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies is the intangibles, meaning they're not items or stocks that company can use right now, but they are the pledges that this company can grow significantly in the future, such as intellectual properties, branding, and schematics. For startups, most of their valuations are based on those intangibles, which could be valued in favorable market conditions. In concrete terms, this means that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below the book value, but it doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place, and that it has deflated itself ever since. As we compare the current price to the historical price fluctuations, the stock is 10.6% higher than the 1-month low, 10.6% higher than the 12-week low, and 10.6% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 217% versus a historical volatility of 128%. The put-call volume ratio is currently around 0.11. It's normal for most stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 13,000 contracts within a day, compared to the 30-day average of 41,000. In terms of open interest, the most recent volume of open interest has been 1.1 million contracts versus the 30-day average of 916,000 contracts. The option contract is a derivative product from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right, and selling the contract giving you premiums with the obligation to execute the rights if that's the wish of the counterparty. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there may be possible uptrends on the move, or that a reversal could happen if there's a lot of call options. The reasoning behind that theory is very simple. Many people trading options try to catch the train when it's no longer there, and as a result, most of those options would expire worthless. In terms of the shareholder structure, institutional shareholders own 10.5% of the outstanding shares, the biggest shareholders including Bluefin Capital, Vanguard, and Citadel Advisors. It is relevant to understand the shareholder composition of a company, as this helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this could be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this, since many great titles that are mostly owned by retails are still worth holding, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there is significant short interest in the making, it could be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 21% of the total float, and 55% of those transactions are coming out of the dark pools. And usually, if the short interest is above 15% of the total volume and a significant chunk of it coming out of the dark pools, this could mean that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. Overall, my recommendation is to first understand the risk of going in VINCO Ventures now, given that the momentum seems to have shifted away from the company. Once the risk involved is well understood, I think that now could be a decent entry timing, because the price level is sufficiently low to justify the risk taking. I would recommend to commit between 1% and 3% of your portfolio to the stock, and would also recommend to split your allocation in batches of 30% at a time so that you could benefit from further retracements if applicable. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.